Hey, today we're going to look at ING. ING is Netherlands' largest bank with a market cap of about 37 billion euros. It is listed on both the Amsterdam Stock Exchange with the ADR listed on the New York Stock Exchange. It currently has a dividend yield of about 6.5%. With the invasion of Ukraine, ING has dropped almost 40% from its peak. From the chart, you can see a recent high of 14 euros and is currently trading around 9.50. A quick note on the dividend withholding tax. Companies incorporated in the Netherlands have a 15% dividend withholding tax. I'm not a tax advisor, so please consult a tax professional if you need help. ING has a relatively small trading desk. If you look at the previous year's results, most of its income is derived from net interest income, which is about 70% of the income. ING's financials aren't very impressive. Revenue growth has been rather stagnant, and is closer to 0.5% CAGR if you take the past 5 years into account. The good thing is book value has been growing, but so has the cost-to-income ratio. The final dividend was not paid for FY 2019 because of the ECB's recommendation, and 2020 profits were affected by COVID as well. Moving forward, I expect ING to be able to maintain their dividend. ING's Russia and Ukraine exposure is about 1% of their total loan book. Without the insurance and guarantees, it's about 7.2 billion euros and 4.5 billion if you include them. It's much more complex than that because of the sanctions and currency mix as well. I'm only going to assume two scenarios. 1. The entire Ukraine and Russia loan book gets wiped off. 2. The guarantees are in place. I got the book value based on the figures from the annual report, since I seem to be getting a lower figure from the balance sheet. In scenario 1, the book value will be 12.39 per share and 13.08 in scenario 2. Now, for some guesstimation. We know that the net interest income in Q4 2021 was 3374 euros, which was generated off a loan portfolio of 787,327 in millions of course. We get a margin of about 0.428%, which results in a decrease of 1.07% in net interest income, which really isn't that significant. Now, this also isn't entirely accurate since wholesale banking has higher margins and Ukraine and Europe has higher risks. Next, ING has 10 billion euros of excess capital. Given their CET1 ratio of 15.9%, which is still 3.5% above their goal, they have 313.1 billion of risk-weighted assets, meaning that 15.9% is equivalent to 49.8 billion. This makes their extra 3.5% equivalent to 10.7 billion. ING's market cap is about 37 billion, which means excess capital is almost 25% of their market cap. Before ING can do any share buybacks, the AGM needs to pass first. This will take place on the 25th of April. The last buyback was 1.7 billion euros, so I wouldn't expect too much, especially since they need the approval of the ECB. While the Fed and the Bank of England have already raised rates, I wouldn't be too optimistic on the ECB raising rates given their dovish stance. Also, they have repeatedly stated that they don't follow the Fed. ING is trading at about 0.67 price to book, when it used to trade closer to 0.8 to 0.9 in recent times. If we exclude the loans from Russia and Ukraine, the current price doesn't look very attractive. However, with the insurance and guarantees in place, it looks much more attractive with some upside still. Now, this is purely based on book value, but ING still pays a nice dividend. In conclusion, ING trades at a discount to the recent book value, has a nice dividend yield of 6.5% that should be sustainable, and the Russia and Ukraine should not affect their income too much. Finally, they are also a beneficiary of rising interest rates.